Welcome back to class. We are in week 2 of OVTLYR University. We're going to be covering so much today. This week, we're going to be working on trading psychology because that is honestly one of the most important, if not the most important part of trading. Now, the exciting part of trading, the part that everybody wants to talk about, are the entry signals. Forget the exit signals, forget the position sizing, forget the risk management, forget anything, right? You go online, the only thing they want to know is, what's your win rate and how did you get in there, right? I'm trying to tell you this because this is so important. You've got to understand that once you're in the game, everything changes, right? How many times you've been in a trade and you had this grand idea of how much money you're going to make, and by the end of it, you're like, whoa, okay, I was not ready for that, right? Has that ever happened to any of you guys? Yeah. Oh yeah. It's happened to me plenty of times. And special guest, Steve Burns today. Steve, author of New Trader, Rich Trader, and all kinds of trading books. Special guest, Steve Burns today. I'm very excited about that. So we're not going to delay any longer. We have so much to cover today. I will be calling on everyone in class. So get ready. Get ready. And let me share my screen. Let's do this. Welcome to OVTLYR University. This is where we help you save time, make money, and start winning with less risk. So go ahead and subscribe if you haven't already. And this is week 2, thinking like a successful trader, right? Lots of people want to come into the market and they're like, oh, yeah, this is easy. Oh, this is the hardest way to make an easy dollar. You're going to hear me say that more than once today because as traders, we need to understand the game between our ears is so much more difficult than the game of the market. So this week, this is what we're going to cover today and on Thursday. We will not be meeting next week for Thanksgiving, so that's okay. You can have a week off. You should definitely read some of the books that I had given you guys ahead of time because what we're talking about here is we're basically going through the content of those books because those books, if people pay attention, if they follow what's in those books with consistency and discipline, they will have dramatic generational wealth changing opportunities given to them like has been given to me. I want you to be successful like that. That's where I'm at, right? That's where I'm at. That's where I want you to be. So the first part of thinking like a successful trader is the road to success: fundamentals, technicals, or mental analysis, right? So let's talk about this, right? What are some fundamentals that people look at? I'm curious to see what you guys would say are some fundamentals. So raise your hand and I'll call on you. I'll give you the floor. What, Carol? I saw you raising your hand over there, right? What are some fundamentals that people look at?
Let's see, the earnings probably is the top one on a company, right? For fundamentals specific to stocks and what type of ROI they're achieving, and whether it's a strong balance sheet in the company.
Yeah, that makes sense. And like there's people who devote their entire trading strategy to combing through all of the financial statements that come out with fundamentals, right? And it comes out once a quarter. So you're telling me that 4 days a year determine your entire investing thesis? I don't know. That seems crazy to me. Mark, what are some fundamentals that you think that people look at, or maybe you look at?
I mean, I would say a lot of people probably focus, on the balance sheets and, looking forward and, looking for like sales trends. Like if you're looking at Tesla, for example, what do they have, that's going to be coming out in the future that you can get excited about. It kind of ties in with the technicals, I guess. But
Well, I mean, product announcements absolutely goes into fundamentals. No, you're totally right there. What about you, Art, Senior Wahoo? What do you think about fundamentals?
I was thinking quarterly reports, P&E ratios, just getting all that noise out there that really makes no difference because it's POP, right?
Right. Profits follow price. But, for the people who work there, for the people who are actually building the business, right? Imagine like trading stocks is almost like trading baseball cards or Pokemon cards or Beanie Babies or Labubus or whatever else that somebody wants to buy, right? If I own it and somebody else wants to buy it from me, that makes a market. Whatever the thing is, it can be Scrooge McDuck Funko Pops, right? I could say, hey, how much would you give me for this Scrooge McDuck Funko Pop? Some of you may say $100, some of you may say $1, right? And some of you may say, I wouldn't give you anything for that. right? And so that would be me and you making a market. But to the people who work there, right, the free cash flows, the let's see, let's go through here, right? The financial statements, the revenue growth, operating margin, earnings per share, free cash flow, capex level, right? So how much are they investing into the business, return on equity, same store sales, all kinds of stuff, right? All of these would fall into fundamentals that could be very useful for somebody who's involved in the business. You as investors aren't really involved in the business at all. I know that sounds crazy, but you aren't. Unless you're a big enough investor to influence what the business is doing, you're just a small fry. So small, in fact, that you can trade off your shares to someone else and it will make no meaningful difference to the company whatsoever. But a lot of people want to put their hat on that and say, well, I'm such a smart, astute, educated investor. But then again, you can have a terrible, terrible company with a great price, or you can have a company with a horrible price that is changing the world, right? And that's where technicals come in. Technicals meaning, what do we see with the price? So let's call on some new names. Rick, what are some things with technicals that people might look at?
Moving averages.
Dude, yeah, for sure. For sure. What does a moving average represent?
So it's the average of the price of the stock over the last X number of days, sometimes
Right.
weighted.
Yeah, it's a combination of price and time, right? And so over time, we can see if price is greater than the average price or if price is less than the average price. Shane, what are some other things that people look at in technicals?
Would the price of the options and stuff like that be considered part of technicals, or are you looking for more like chart related?
Oh, it can be, right? I mean, what in the price of the options is important to you?
If you're, I forget what it is, but if it's, above 30, then, that's like not really worth it at that point.
There you go. I like it. I see where you're going. You're talking about the extrinsic value, the uncertainty value, right? We want to lower, right? We want to keep that as low as we can because that's the part that will decline over time. And we'll cover more about that later on in other classes. Charlotte, what are some things that you might look at if you're looking at technicals?
I do the same as everybody else, the EMAs. I also use the MACD. I'll always jump onto OVTLYR, of course, and check there as well. That's part of my text.
I love it. Hey, thanks for the soft pitch right there, Charlotte. That was great. So here's some things that I wrote down, right? Some charts, right? Like y'all were talking about, different indicators, right? There's literally thousands of indicators, and when you put into account all the settings inside of each indicator, it could be potentially billions of different combinations of indicators out there. Price trends, support and resistance, different gaps and goes, gaps and craps, moving averages, like we talked about, breakouts, breakdowns, all kinds of stuff, right? There's all kinds of stuff that you could look at in fundamentals and technicals, right? Now, what about mental analysis? What about mental analysis? Let's see, Stocky Locky. What do you think that somebody could look at for mental analysis?
Well, I'd say mental analysis. Would preparing your plan properly be one?
I think so. Yeah, I think so. What do you think, William? What are some areas of mental analysis that you could look at?
This one's a little tricky to me, but I would say, just like Stocky Locky said, having your plan, but also being able to stick to it, preparing ahead of time, and actually being able to execute the plan rather than trying to decide on the fly, emotionally. Ooh, should I get in here? Oh, hold on, it's going up. Oh no, wait, okay, turn back around. What do I do?
Right.
If you have your plan ahead of time, you can execute it more cleanly.
That's a brilliant point. We're going to be talking more about that later. In fact, you'll even hear baby boy Chris, little teaser there. Baby boy Chris from ages ago talking to his mentor Steve Burns about specifically that. Mark, what do you think?
I was gonna say, like, are you in the right frame of mind to make this trade? Like, where are you at mental state? Like, do you have a bad day? Is it really stressful? Are you going to be able to make decisions without emotions, or is what's going on in your life going to cloud your judgment?
Dude, absolutely right. And, you know, before, during, and after a trade is a great point to be looking at your emotional state, right? Before a trade, are you chill? Are you like, okay, this is what I'm going to do? Or are you amped up like, oh my gosh, I cannot wait to put this trade on, right? Or maybe you're just bored. I got nothing else to do. I'll just put some trades on, right? So I think trading intention is really important as well, right? Was it part of the plan? Did you have a plan? Was it FOMO that you got into something? Were you afraid that everybody on the internet was talking about how they're making so much money, so you had to buy it too? Were you just bored? Right? I remember years ago somebody telling me, if you aren't trading every day, you can't call yourself a trader. I disagree wholeheartedly. Right? There are times to be aggressive and there are times to be defensive, and then there are times to just get the F out the way. You don't have to be doing anything. Sitting in cash and not effing up your portfolio is part of a successful trading plan. Sounds crazy, but it's the truth. You got to have self-awareness, right? Do you have a bullish or bearish bias on the stock? Are you trying to tell the stock that it should go up from here? Are you trying to say, you know what? I definitely have a great feeling about this stock. It absolutely has to go on a run right here, right? Setting profit targets and anchoring to certain price levels cost you. Why is that a bad idea to set a profit target and anchor to a certain price level?
That's a great question. Well, one, you don't know if the stock will ever get to your profit target, or it could take so long that it absolutely makes no sense. Why would you wait 30 years for the stock to come back very, very slowly when you can do it in 3 weeks? So just money, efficiency of money is quite important in here.
Ooh, I like that. That's a good way to describe it. But Kasia, listen, I did all my analysis. I know that the price is going to $200 a share. I know it's going to happen. Okay, I'm not going to sell until it hits that $200 a share. What would you tell me?
I would say that you follow your plan, so that's very nice. I will follow my plan because I want to grow my portfolio at following my plan where I actually grow it fast because I want to get to be a wealthy person as fast as possible. The problem with the target is that the stock might never reach that target, and there's been many cases where the stock actually goes down to or disappears completely. So having a target, what if it's $1 off? Are you gonna wait to sell it? Like, what if it's a cent off? So if you have a target and then you buy it when it's 1 cent lowers, then you're breaking the rules. And when you're trading and breaking the rules, even if it's a successful trade, then the system is not successful.
Yeah, well said. I love that. And you mentioned something earlier that I really stress in that we absolutely do want to get rich quick. I know that sounds scammy AF. YouTube's going to ban me because I'm a scammer, right? But here's the deal, right? If it takes you 20 years to make $1 million and it takes me 20 months to make $1 million, I'm moving 12 times faster than you. That means I can have 12 times more enjoyment of that $1 million. Everything is that much better because I got to the same $1 million 12 times faster. I think that's really important, right? We do want to get rich quick, but we need to make sure that we do it in a way that is not just gambling, but actually has a systematic edge built into it. And then we just let that edge play out. Go ahead, William.
I wanted to add to that because I've heard you say it so many times is, you set a $200 price target as well. And not only will it possibly not go there and then come all the way back on you and you're still holding it, but what if it does hit 200 and you say, good, made my target. I'm happy. And then you take it out and you look 2 weeks later and it's at 260 now. What was your plan? Shouldn't you follow it up while it's trending? And then if it makes its reversal, go ahead and exit? How do you know where to get out ahead of time?
Yeah. Brilliant. Sounds like you listen to random guys on the internet. I love it, dude. Hey, who knows what the most dangerous word in finance is? Does anybody know?
Should.
Anybody know? Stocky Locky. What's the most
Should.
dangerous word in finance?
Should.
Wait, why would should be so dangerous?
Should and could.
But why? What makes it dangerous?
It's predicting the future.
I like it. I like it. Art, what do you think about that? Why is should the most dangerous word in finance?
You're anticipating something to happen, and that market may not give that to you, and you have to accept what the market's going to give, good or bad. And on the other side of when we were talking about the gaining, we also have to be self-conscious of when we're going to get back out. We're just going to give it 5 more cents, just 5 more cents, just one more day. It'll come back. I promise it'll come back. So
That's right.
Get rid of all those.
And a lot of people who want to tell you how a stock should behave have a personal attachment to the stock, right? They can't see objectively what the stock is doing. They're so blinded by their greed. They're so blinded by what they are telling the market it needs to do that they cannot accept the fact that Palantir, SoFi, Tesla, etc., can go down just as likely as they go up. They get so emotionally involved in the company, and they've seen the price go up before, and if it's gone up before, then it should do it again, right? If it's had a 500% up move, then obviously it's going to go 500% up again, right? Why wouldn't it? Because of people's biases, they get themselves into huge trouble because they try to tell the market what it should do rather than just paying attention and listening to what the market's doing. And these are really key points here. Really key points here. Mastering trading psychology matters more than predicting the market. More. Because it doesn't matter how great of a plan you have. If you can't follow that plan, you don't have a plan. You have a hope and a dream. But let me ask you this. I'm going to ask you directly. Who am I going to ask? I'm going to ask Charlotte. I'm going to ask Charlotte directly. Why would I trade if I don't know what the outcome will be? Oh, hang on, you're muted. I unmuted you though. Go ahead.
Well, every trade we take is that way. We don't know the outcome of any trades. If we don't get in the race, then there's no chance of winning. So,
oh, that's a great analogy. I remember having that conversation with myself one day. It's like, why would I put on a trade if I don't know what's going to happen? Carol, why would you put on a trade if you don't know what the outcome is going to be?
Well, from a statistical perspective, right, there's going to be losing trades regardless. So playing into those numbers, you have to take the trade if it's set up, because we don't know the outcome, but we want to eventually get to the winning outcomes that would be more than the losing outcomes. That's success.
True, but I mean, have you seen SoFi? It is the future of finance. It's gone up like 200% just in the last year. Carol, surely it'll go up, right? Because like, why would I risk anything if I don't know if I'm going to win?
Well, you could risk it, but that's against your plan if it's not trending in the right direction. That's what our trading plan gives us, right? So we have to meet the criteria in order to enter the trade. And you have your exits already planned. So when things change, you're able to exit according to the alerts that you get. So it would be a risk. And SoFi is one of those meme stocks that is all over the place, lots of volatility. So lots of opportunity to lose and win.
And win, yeah. These right here are questions that are fundamental to somebody who's new to the market. Why would I trade if I don't know what's going to happen? Why would I risk anything to find out if it's going to happen? Once you can overcome these hurdles, that's a huge game changer for you. Right? These right here are two of the biggest hurdles. Why would I trade if I don't know the outcome? And why would I risk my money if I don't know if I'm going to win. Now, I struggled with this too. But being a successful trader means embracing the uncertainty. Sounds crazy. I know that it sounds like I came to OVTLYR University to learn how to win, not learn how to lose. You're not going to win every trade. I wish I could give that to you, but it's just not going to happen. However, given enough trades with a positive edge, and we'll talk more about that in a minute, given enough trades, you should, dangerous word, eventually come to your expectancy. Let's continue on here. What are some of the lures and dangers of trading? This is going to be fun. I can't wait to hear. Can't wait to hear this, right? Let's see. Stocky Locky. Oh, you were gone. Now you're back. Okay. Stocky Locky. What are some of the lures, the exciting parts of trading? All right, he's frozen. Kostya. What are some of the lures of trading? What's some of the exciting parts of trading?
Yeah, I think initially a lot of people who are long-term investors, they're just hoping that slowly it'll come up. But as you start doing more kind of day-to-day or short-term trading, there's a lot of videos on YouTube or books that promise amazing outcomes. And they say, look, here's your $10,000 a month strategy. What they don't tell you is, well, it takes $5 million to get to that $10,000 a month. Or they don't tell you that that was just 1 month they've hit, luckily. So the allure is like everyone's trying to get hits on their videos and showing how amazing results you can have or strategies that they give you. For example, the video that we watched earlier today. However, they're introducing very dangerous methodologies that can actually make you lose money very quickly.
Yes, and the lure of trading is the money. Absolutely the money. We're gonna try this again. Stocky Locky.
Can you hear me?
Yes, for now.
I was going to say Lambos is a lure and danger.
Lambos, baby. Is there any other reason to trade other than Lambos? It's only Lambos or nothing, right? Lambos or food stamps. There's nothing in between.
It's the social media, obviously, just to elaborate, it shows you the high life. So there's an expectation to get rich quick. Rich quick?
Dude,
Dude.
you're pulling a Chris on there. I love it. Nicely done. Rick, what's some other reasons that you think that people get into trading?
I was going to say you might be lured into sort of revenge trading if you're down already. You might be sort of thinking, well, I just need one good trade to go my way, right, to make all this back. So, maybe I'll do double position this time, and that could be quite dangerous as well. But it's both, isn't it? It's both a lure and a danger.
Yeah, well said. I like that one. So a few things I wrote down, and you're all correct, right? Lots of money, freedom from a job, retirement, traveling the world, living the easy life, right? All of these things and lots more others are some of the reasons that people get into trading. People get excited in trading, right? And same for me, and probably same for you as well. But let's talk about some of the dangers of trading. Art, what do you think some dangers of trading are?
I really want to do the lure was going to be Batman.
Oh, go for it. You can say that too. That's fine.
Batman watches. Gotta have my Batman watch.
Batman, dude, you just wanted me to flex on the Batman watch. Yeah, I know what you're doing. And that's a great answer, right? Fancy watches, fancy cars, all kinds of fancy stuff, right? And it makes it a lot easier to buy fancy things when you got more money. I totally agree. But tell me a dangerous thing about trading. Art, back on you, sir.
Oh, sorry. I muted myself. Trying to mute myself and not be on, right? You get caught up in the FOMO, and you get caught up into doing trades you shouldn't be doing. There's lots of things that can, you know, Henry today. I love how you rage quit in 7 minutes. That was awesome. Charlotte called it today. 7 minutes, you were gone. But yeah, just listening to other guys out there and not focusing on your plan. That's you just got to stay focused, and the psychology of trading is super tough.
Mm-hmm. For sure. Great answers. Shane, what are some dangers that you can think of with trading?
Your mental stability, because I know when I first started, I was sitting there just thinking like, why is the stock not going up? It should be going up, but it's not. And it just kept me up at night just thinking about the amount of money I was losing.
Ooh, that's a good one. Yeah. Mark, what do you think of some dangers?
I mean, it can be easy to let your emotions run out of control, you know, especially on the win side. You ride that high and then you throw your risk management out the window trying to chase it. And the next thing you just hit that boom bust cycle.
Dude, well said. I love it. So a couple things that I wrote down, and you're all correct here, is that you can lose everything that you worked for in your entire life. You can literally watch your life savings evaporate if you don't know what you're doing. You can lose $200,000 with an 84% win rate if you don't know what you're doing. Plenty of people have offed themselves for this exact reason. I hate to get to that point, but it's true. Jesse Livermore, one of the greatest traders early in the 1900s, had made tons and tons of money. Like I saw somewhere that, like, if you translate it in today's dollars, he would have made and lost billions of dollars because he was so good at his craft, but also mentally, he was so good at giving it away. And the story is he offed himself for that same reason. Families have been destroyed because a trader turned into a gambler. Investing in anything has risks, but because of the ease of access of the stock market, those risks are elevated and those risks happen faster. And once you forget about risk and only focus on reward, the only thing that can happen is that you lose. So as a trader, you have to come at it as a situation of, how much can I lose in this trade? How much, Mark, going to what we talked about last week, how much will it cost me to find out if this trade is going to work? If that cost is too much, trade smaller. If that cost is not something that you're willing to take, don't take the trade. There's all kinds of reasons not to trade. But of course, there's all kinds of bad things that can happen if you decide to trade without knowing what you're doing. All right, let's keep going here. The fiction, right? What you see online, trading sexy, right? There's tons of movies. There's YouTube channels, right? There's all kinds of culture online about how sexy trading is, how making money is so easy, right? Every time you turn around, these fake gurus will say, "Bro, can you believe that I made $64,000 today? So easy, right? Oh man, I'll have 3 million by the end of next week. It's so easy. Just pay me $2,000 and I'll tell you just how easy it is. Take my masterclass and pay me $12,000 a quarter and I'll tell you just how easy it can be." Right? The flashy lifestyles. One thing that Mahesh has actually reached out to me is he's like, "Listen, Chris, that's not the image we're going for. I've got money." But he specifically said, "We don't want you to be flashy. We want you to help our traders. We want you to help them make as much money as humanly possible, but we don't want you to be flashy. We don't want to sell that dream. We want to sell the reality of trading," right? And that's why, I don't divulge much about my personal life in that regard, because I want you to focus on your plans and making money in the market and less about the Lambos, right? Less about the flashy things, okay? Or, what color should I wrap my Ferrari? That was one of the most tone-deaf things in the history of humankind. When the Joker was, and this was months ago, he was talking about how AMD was the greatest investment of all time, as AMD is going down, losing 50% or so in the span of a few months. And then he comes on and he says, "Hey, this is my Ferrari out my garage. What color should I wrap it next?" And I remember Mark, our chief strategist, he texted me. He's like, "How tone deaf can this guy be?" Like, he literally is watching his investment, if he's even made that investment, his investment going down day by day by day, his followers watching their money evaporate day by day by day. And he has the audacity to come out and say, "Hey, what color do you think I should wrap my Ferrari?" That's fiction. The reality is the hardest way to make an easy dollar, right? Because you have to have a trading mindset that normal people can't have. You have to adapt to what the market actually shows you, because you can't be successful and normal at the same time. We talked about this last week. You can't be successful in the market and be a normal person. You're going to have countless nights doubting yourself, like Shane was talking about, right? How many times did you lose sleep thinking about a certain trade, right? Facing losses over and over and over, and then watching fear, uncertainty, and doubt about yourself if you'll ever make it. Trading is freaking hard, but that's not how it's perceived online. And that's why I wanted to show you the reality of trading. That's why my job is to help you be successful. And the mental side of it needs to come before anything else, right? There's thrill seekers. They're in it for the action. They want the lifestyle, right? Those Lambos are food stamps. We're either going to go big or we're going to go broke. There's no in between. I would not ever do that, right? You got to risk big to win big. And then there's the perfectionists. The perfectionists will never trade, right? They think if they find the one perfect strategy, they'll never lose. But at the end of the day, they're too afraid to trade, which is why they keep tinkering and tweaking and working on their trading plan, because eventually they'll find the perfect plan. And once they do, then they'll be super happy. Skinny Buff Guy William says, "This might be me." Is that true? Tell me all about it, William.
Oh no, it's true, unfortunately. Yeah, I mean, you're always looking at something and thinking, okay, I should do this, or oh, did they think of this? There's obviously nothing that's going to result in a 100% winning strategy, and I'm aware of that. It's not a perfectionist like that. I'm actually striving for something unrealistic, but I definitely am afraid of that adversity. I think one of the things when you're first starting out is you can go one of two ways. You can either look at the market and get kind of sucked in by those fake gurus and say, "Oh yeah, I could do this. If this guy can do it, I can do it. It's so easy." But there's also a realistic part of other people who are like, "No, it's not that easy," and you are skeptical and you are questioning everything. So you don't want to come out right away and start experiencing losses, because at least in my case, I look at it like, okay, if the S&P is going to return me 10 or 11% per year, I have to outperform that. So I don't want to start out my first year with a negative 20% year, right? I want to come out this way. I'm kind of, playing with house money, so to speak. But I think that's kind of dangerous too, because then you don't take trades. And I have definitely stayed out of a lot of trades because of the risk. I felt the risk, or I wasn't quite ready emotionally.
Well, this is great, dude. And I'll be very transparent with you, right? My family gave me money to invest right when we hit our losing streak in the summer. And they do ask me every once in a while, what's my balance? And I'm like, look, we're down, right? My account's up and your account's down. Sorry. And it's like, well, what do you mean? I should be up just like you. Unfortunately, in the distribution of wins and losses, we don't get to pick when they show up. And earlier on in the year is when I had more big wins. And in the summer, I had some losses. And because of that, it took their account down. It took my account down too. But to your point, right? If I had started with a higher equity balance, it's a lot easier to stomach those losses. But we don't get to choose when that happens. And it could be your first 4 trades are losers. It really could. Could be your first 12 trades are losers. But it's that 13th one that pays for all 12 and more. And that's why you have to have that plan in place, right? And of course, the thing here is that you might want to be in control of the market as a perfectionist. That's impossible. This is never going to happen. Never going to happen. So fear and greed is what moves the markets. And you have to divorce yourself from that fear and that greed, because this is the human instincts that drive the markets, and you have to take yourself out. Right? If you're driving the fear and greed car and you see how it goes up the slope of hope and down the wall of worry, if it runs the market cycle, you have to take a step back off that car and say, wait a minute, I see what's going on here. Oh, okay. I see what's going on here. The stock is going up because people are getting more and more greedy on the stock. Fantastic. But at a certain point in time, there's so many people who have gotten so greedy that there's nobody else to get greedy with. And then therefore, those greedy people are going to turn fearful, and therefore it will cause the price to go down. This is how the market operates. And you can't control any of it. You just have to focus on your entry and exit signals. And when you have an edge, and we'll talk about edges more in a minute, but given a profitable edge, a mathematical edge, a higher probability of one outcome happening than the other, given enough instances, not 4 trades, or like 40 trades or 400 trades, the closer you can get to what that edge actually is. And when you do this enough times, you can't help but be successful. Profits happen automatically. Let me repeat that. When you have a statistical edge and you follow that edge to a T, given enough trades, success happens automatically. But most people can't do that. Normal people can't do that, right? And there's the illusion of control. As much as we want to tell the market what to do, you can't tell the market anything. But you can control your trades. And if you ever lose control, the market will destroy you. And I like to think of it like an ocean, right? Like Kostya, he loves to sail. He said one of his goals is to sail around the world. And when he gets on his boat and he's going to sail from, let's say he sails from Boston to Dublin, right? Let's say that he's craving a Guinness straight from the source. So he's going to go to St. James Gate in Dublin, Ireland to get himself the freshest Guinness possible, which is tons of fun, by the way. The Guinness factory is amazing. He's going to get in his boat. He's going to decide the day he leaves, and then he's going to follow his plan, but he doesn't know what the waves are going to look like. There's going to be bullish waves and bearish waves. There's going to be sharks that are out there, right? He's even going to float right over the Titanic. But unlike the Titanic, Kostya doesn't have the hubris to say this thing is unsinkable. He's not aiming for the icebergs. He's trying to move around them. And so he's going to get to his destination, just like he will get to a profitable edge that will lead to automatic gains given enough occurrences. So our job here is to profit from other people's fear and greed while learning how to manage your own. So next, we got to talk about taking responsibility for your trading results, right? This is hard. This is really hard. One of my all-time favorite quotes that I ever heard is the decisions of your past are the architects of your present. That came from one of the Dan Brown books. I forget what it was. But he's the guy who wrote the Da Vinci Code, Angels and Demons, Origin. He just wrote a new one called The Secret of Secrets that I read a couple of weeks ago. The decisions of the past are the architects of your present, right? Where you are at today, in your health, in your home, in your finances, in everything, is because of the decisions you made in the past. Keep in mind that responsibility also means you are in control of your future. I love that thought. If I'm in control of what happened to me in the past, that means I'm in control for what happens to me in the future. So Rick, what does taking responsibility in your trading mean to you?
I think what we often see in Outlier in the community actually is people sort of bailing on the plan. They sort of say to themselves, I'm going to follow the plan, look at these amazing returns. It's got to go up. You know, it sort of leans into the whole thing of it should go up. It should do nothing but go up. And then when it doesn't, they're immediately like, oh, this invalidates the whole thing. It's all Chris's fault. You know, it's not my fault. and they bail from the plan. So I think you really need to sort of own that decision yourself. If you're making the decision to follow a plan that somebody else has come up with, it's still your decision to own that, right? You can't then be blaming anybody else if you think it's a failure.
Dude, that's great. Really well said, Rick. I like it a lot. Shane had his hand raised. Shane, what does taking responsibility for your trading mean to you?
Well, one thing is, you get into a trade and goes up a little bit, and then it immediately starts to go the other direction. It's not my fault. It's the market makers. They're out to get me.
Dude, we hear that constantly. Even some really bright people that I know like to push this whole "they're out to get you" narrative, right? Nobody's out to get you. Actually, we're getting ahead of ourselves here. And also, no one's coming to save you either. This is a battle of one. Charlotte, what does it mean to you to take responsibility for your trading? Hang on, you're muted again. I got you. Go for it.
One of mine is actually right back when I start the trades, because I do hesitate. I just have to remind myself that one of the things you always say is that if everything lines up, you must take the trade. So
Yeah.
I'll do that for myself as well. Otherwise, I won't get in the trade. So that's
I
one of
think
my
that's
responsibilities.
I think that's a great idea, right? Even Mark Minervini, one of my mentors, he likes to say that I don't know how true this is, but he claims that he says this, right? He'll look himself in the mirror and say, I have the power to destroy everything that I've built today. I have that power. You know what else that means, Carol? We have the power to make incredible things happen. Right? Taking that responsibility, taking that ownership, right? But also at the same point, you play stupid games and you're going to win stupid prizes. All right? Let's be real here. You do stupid shit, you're going to get stupid prizes. Okay? We want to avoid the stupid games when it comes to trading. That's what I'm trying to help you with. That you're 100% in control of your trades, which means that you are 100% in control of being a successful trader. Who said this? I know it was one of you guys who said this on the live stream yesterday or the day before, right? If you have a 10% loss, then you're considered a degenerate. But if you watch your account go down by 30%, you're normal. Was that you, William?
Yeah, it
Tell me
was.
about
I
it.
was saying about the buy and hold. If your buy and hold position goes down on the S&P, you're just holding it. That's perfectly normal. That's acceptable. But yeah, if it goes down 30% doing that, that's acceptable, right? But if you're out here trading day to day and you lose 10% of your portfolio on a handful of trades, ooh, you shouldn't have done that. That's risky behavior. Why are you trading? Yeah. But
Time
we're not
in
normal.
the market. Oh, sorry. I didn't mean to interrupt you there. Go ahead.
No, but we're not normal, you say.
No, we're not normal, right? People will tell you time in the market beats time in the market every time. That's not true. When you have to sit on a 30, 50, 70% decline, or you could just sidestep the entire decline and then only buy it as is crashing up, right? That's not normal. People don't want to admit that they actually can time the market. Will it be perfect and you buy every bottom and sell every top? No, of course not. Of course not. But you don't have to. You don't have to buy every bottom and sell every top. You get to decide how much money you're going to make. Mark, what does that mean to you? You get to decide how much money you're going to make.
I mean, you're in control of your own destiny. You know, it's when what stuck with me from last week was, the difference between the gambling and the investing is one of the big differences is you control how much you lose. You can take your chips off the table at any point, and that works on the upside too. You
Mhm.
can take your chips off the table on a winning trade, and you might do it early, or you might do it a little too late, or you might do it just right. But unless you have that defined within a plan, you're guessing at where it is. But it's ultimately up to you and how you react, whether you follow the plan or not.
Well said, right? I mean, you took the words right out of my mouth. You get to decide how much money you make by letting your winners run. You get to decide how much money you're going to lose by cutting your losers short. You get to control this part. That's the crazy, crazy, crazy scam, fake guru aspect that people want to talk about in the market. Wait, what do you mean? You get to decide how much. Well, if I get to decide how much money I'm going to make, then I'm going to make 1,000% on every trade. Well, you don't get to decide which trade will be a winner or a loser. But when it is a winner and it's running, you might actually make the 1,000%. But if it's going to be a loser, you don't have to lose 1,000%. Could you imagine losing 1,000%, 10 times greater than your initial investment? Good gravy. You actually get to cut your loss as short as you want. But you have to give up the expectation on the outcome of the trade, because this is the part that you can't control, right? Even though I say you can make as much money as you want, you can't determine where that's going to end up, right? If it's on a trend, you don't get to say the trend stops at $99. It won't get to 100, but it certainly is going to blow right past $80, because the outcome of that trade is random. It will be a win or it will be a loss, and sometimes it'll be a break even. And there's nothing you can do to make it a winner or a loser. There's no amount of manifesting. There's no amount of prayer beads. There's no amount of candles at church that you can light that will make it a winner or a loser by your own regard. But you get to decide how much money you're going to make in the trade, and you get to decide how much money you're going to lose in the trade. And that's freeing right there. Wait, what? I get to choose how much I'm going to lose? Okay, cool. I get to decide how much I'm going to make? Sweet. But I don't get to choose which one will be a winner or a loser. And I don't get to set the outcome here. So, to Shane's point, you got to stop blaming the market makers, the short sellers, anybody else. There's no one out to get you. The only thing that you need to know is your plan. Follow that plan. When it's working, let it work. When it's not working, get out of the way. Don't overcomplicate it. Have a proven mathematical edge. Have an entry signal, have an exit signal, and then you need to follow it with consistency and discipline. So speaking of consistency, let's talk about consistency. What does success look like to you? Carol, as you're drinking from your cup, sorry.
That's okay. You've been getting me today every time.
That's the plan. That's the plan.
It is. What does success look like to me? Following my plan, getting out when the indicators say to get out, the alerts, and when to get into a plan, how to enter it, and following the plan with the freedom that Outlier brings you. That's success.
That's the most perfect answer ever, Carol. I wanted to make a joke about it, be like, no, really, what color is your Lambo, kind of thing. But no, you're totally right. You're totally right. That is what success looks like, is having a plan and following that plan, right? So Stocky Locky, you ready? Pop quiz. I can see you moving. I can see you smile. I think everything's working. Pop quiz. What are the 4 types of trades?
Good trades, bad trades, winning trades, and losing trades.
Gold star. Well said. All right. Well done, Rick. What are the 4 types of outcomes of a trade?
Is that the combination of the two? So you can have good trades that are winning trades, good trades that are losing trades, bad trades that are winning.
Itty bitty.
Oh, it's a good answer, but it's not the one I'm looking
Oh, sorry,
for.
yeah. The small loss, break even, small gain, big gain.
There you go. A big win, a small win, a break even, or a small loss. Exactly. These are the things you've got to remember. There's 4 types of trades: good trades, bad trades, winning trades, and losing trades. A good trade is one where you follow your plan regardless if it's a winning or losing trade. A bad trade is one, regardless of a winner or loser, is when you didn't follow your plan. Even if you followed it on the entry and then you panic sold out of it, that's a bad trade. And the 4 types of outcomes, what we can control. Remember, we get to choose if it's a big win, small win, break even, or small loss. But we don't get to choose in what order the big win, break even, small win, and small loss come in, right? We don't get to choose when they happen, but we do get to choose how much or how little, how much we can make or how little we can lose. So to me, success looks like consistent execution of a winning edge. Now, the things that happen when you have a winning edge are great. Big, beautiful houses, Batman watches, all kinds of great things can happen when you have consistent execution of a winning edge. So, what is expectancy? So this is related. Mark, what does expectancy mean when we talk about having consistent execution of a winning edge?
Eventually what the positive outcome is going to be if we execute that time after time after time over X number of trades. Goes back to that distribution curve.
Nice. And so when we talk about the expectancy in our trading plans, it's how much you could expect to win or lose on average given enough trades. I'm gonna call on Shane. If I have 3 trades and all 3 are winners, does that mean my expectancy is basically going to the moon?
Not necessarily. You don't have enough data to, make a good, or to show your expectancy with just 3 trades. You need more trades.
But these 3 trades were winners, and 2 of them were small winners, and one was a huge winner. So therefore, that means that I must have the world's greatest trading edge, right?
Yep, 100%. You're good. It's YOLO, all of it.
It's good until it's not.
That's right. Let me ask Carol. What about if the opposite's true? What if you put on plan ETF, you have 1 small win, 1 small loss, and then another small loss? Does that mean plan ETF sucks balls so hard that nobody should ever do it?
No.
But it's not working, Carol. It has 2 losses in a row, Carol.
That's all part of the plan. You're expected to lose. So you're getting.
What do you mean I'm expected to lose, Carol?
You're expected to
Hang on.
lose. So, yeah.
This is going to be fun. Carol, we're going to role play. You ready? This is going to be a lot of fun.
All right.
This is the little inner gremlin for most people. What do you mean expect to lose? I don't expect to lose. I expect to win.
Not all the time. Nope. You got to, it's part of the statistical averaging probability. You will lose. So get it done early. Get them done. Lose, but cut your losses quickly so they're small.
But Carol, I'm a winner, or I want to be a winner. And if I lose, then I'm a big baby with a diaper on and I can't handle it. What am I supposed to do?
Well, then I guess you could take your lunchbox and go home.
Oh, I like that. Actually, I like that a lot. Yeah, if you can't handle it, and if you can't handle the heat, get out the kitchen.
There you go.
Yeah. All right. So what if I took the trade 100 times, Carol? What if I took that trade 100 times?
Then the expectation would be you'd win between 40 and 60%.
So it's kind of like a coin flip, huh? How dare you walk right into exactly my example?
Like a coin
Kinda
flip.
like
There you go.
Yeah. Like if I flipped a coin 3 times in a row and it came up on heads every time, clearly it's a loaded coin and it must always land on heads, right?
Wrong.
Wait, what do you mean?
Well, it's the odds of the flip.
So you're saying that I'm tying this all together. Got
No,
a big old
you're-
bow right here. So what you're saying here is that each individual flip is a random outcome?
Yes. Unless the coin is rigged. But
We're
yeah.
going to imagine it's not rigged for this example.
Okay. Yes, it is a random outcome.
But Carol, I want all the winners. I don't want the losers.
You can't cherry pick. You have to lose to win.
So what you're saying is that the more times that I flip it, the closer that I get to the expectancy that we've developed given our historical back tests.
Yes. Because you have the data. You
Right.
did all the back testing. Yes.
Right. But each individual trade, we have no control of what the outcome will be.
That's
But given enough trades, we should eventually land in on what the expectancy is, or at least get really close to it.
correct.
And that's why I like to use this as an example, is because, any one time it could be heads or tails, and it could honestly be 10 heads in a row. But the more you flip, the closer it gets to the expectancy. And that, as a trader, is what we need to have in our back pocket. So we can always say, hey, you know what? I know what my expectancy is. Let's go with it. So expectancy it's a math formula, actually. It's your average win. Your win rate times your average win. So for example, like a 60% win rate times a 5% average win minus your average loss times your loss rate. So that would be 60% win rate, 40% win rate. And let's say if your average win is 5%, your average loss is 7%, whatever that math comes out to. We're not going to do it right now. That would be your expectancy. And if you have a negative expectancy, the more you trade, the more you will lose. Charlotte, where do you think you have a negative expectancy? Hang on, I'm going to unmute you. Okay, go.
What do you mean by where?
Yeah, exactly that. Where, in what circumstance would you have a negative expectancy? Arguing with your wife always results in negative expectancy. I'm just putting that out there. And if you are a wife, you have positive expectancy. But the answer I'm looking for is a casino. You have negative expectancy in the casino. The more you play at the casino, the more you will lose. Period. Full stop. You may hit a couple big wins, which is great. But you better believe that casino understands that if they have a big payout, they don't care. They know their edge. And given enough suckers walking in the door, all of them, every single sucker walking in that door has a negative expectancy. So they're like, here's some free drinks, here's some free rooms, here's some free anything. The more idiots we can get to walk in the door, the more we're going to make. Now, you as a trader, you get to create your own expectancy. You create how big of an edge. You get to say, you know what? This plan has an edge of 1.2%. That plan has an edge of 2.5%. Sounds kind of like plans A and M. And you get to choose which one you play with. You get to do that. You get to be the casino in this case. But just like a casino has a payout and they will lose on that payout, you can have a losing trade. And given enough instances and giving more and more trades, you get closer and closer to what that expectancy is. So I think that's great. That's exciting to me, right? The more data you have, the more accurate you can be. To that example earlier, if you have 3 trades in a row, that's not enough data to come up with expectancy. Like, you really want as much as you can. I'm talking like 50 at the minimum. 100 sounds even better. 1,000 even greater. The more trades you take, the closer you get to that mathematical edge. So how do you create an edge? That's a great question. Mark, I know you were thinking that question. How would you create an edge?
Yeah, well, I mean, you can create a lot of different edges depending on, what you're looking to do. Whether or not it's going to be riding the EMAs or just looking for trends, or can depend on how sharp that edge is, I guess.
Mm-hmm. I like it. William, how would you create an edge?
I think you've got to develop your plan and then stick to that plan for at least enough trades so that you can get enough data so that you can back test it and know whether or not it's a positive expectancy or not. And if it's not, after, boy, I don't know how long you have to wait there. I know we've talked about 40 trades before, but I don't know how long you want to stick with the losing edge if you haven't proven that it's a winner yet.
Dude, I think that's a great point. There will be times where an edge feels tested, right? Where you have that 60% win rate, but you happen to hit the 4 losers in a row or the 40 losers in a row. Good gravy. But then the next 60 are winners, right? That can be really tough. That could be debilitating for lots of people. So that's where backtesting and journaling and trial and error and paper trading all come in, right? See if that trading plan actually works. Prove to yourself that it works. If it only happens when it's Friday the 13th on a leap year, you don't have a trading plan. But by God, every Friday the 13th on a leap year, boy, does that thing work. What a perfect edge it has. Wins 100% of the time. Shane, what were you thinking?
I just have a question regarding backtesting. When you backtest, would it help to include the stocks that you didn't take, but they fit in your trading parameters? Would that help out with your expectancy?
Of course. Yeah. The more data you get, the better, right? Now, if let's say, for example, that you're following a plan and it shows up with 100 trades in a single day, there's very few people who could put on 100 trades on a single day. Let's say you put on 5. The other 95, honestly, that's the only part of luck I think there is in trading, because all of them set up on the same day, but you only have capital for 5. The other 95 are going to do what the other 95 are going to do. But the more of these events that you take, the more of the 5s that you take, right? 20 different occurrences of 5 trades will still equal the same 100 as if you took all 100 in a single day. So yes, I agree completely. Any data method that you want will work, but you have to have defined and strict entry and exit criteria. If you don't have defined and strict entry and exit criteria that you can see and plot and follow precisely, it's not a plan. You guys have probably seen this guy before, Richard Dennis. He's the one who created the turtle trader experiment. His idea was that traders can learn the rules to be successful in the markets. And he says, I would say you could publish the rules in a newspaper, but no one would follow them. The key is consistency and discipline. And everything that we talked about today, and I know I'm going long. I always go long on OVTLYR University. Sorry. This is my favorite thing in the whole world. So sorry, not sorry. I told you guys that I will over deliver in every way, shape, and form in OVTLYR University because I want you to be successful. I'm not holding anything back here. None of this matters if you don't have the consistency and discipline to follow the plan. And even on a day where it looks like the market's going to shit and you're like, what am I going to do? I can't stand this anymore. I have to get out at 12 p.m. instead of waiting for my exit plan when I normally get out at 3 p.m. And then I've completely blown the whole plan because you know what happened? Exactly at 12:01 is when it started to go right back up. If you don't have consistency and discipline to follow those same signals every single time, it doesn't matter. Wait. I get to do it. Hold on. I know all of you guys are like, what does he mean? It doesn't matter. And what is he getting all excited about? It doesn't matter.
Is that what you think? That's exactly. It doesn't matter what you think.
What? Wow. Now that is some serious disrespect right there, JR.
My favorite part of that clip is when the guy goes, that's some serious disrespect right there. But it doesn't matter. If you can't follow the plan, you can't do it. Even just once. Even just this one time. Listen, Kostya, just this one time, I'm going to break my plan and get out before my exit signal happens, right? That should be fine, right, Kostya?
The struggle is real.
That's a great answer, actually. That's a brilliant answer right there. The struggle is real.
The struggle is real. You know, one of the things that I wanted to add was, as a new trader, one, I didn't know what it meant to make a plan. Like, what does that mean? Like, I don't know what I'm doing. I'm new. I don't know how to program. I don't know how to create these like 1,000-line spreadsheets with all the buy and sell signals and order blocks and what the hell is order block and there's too many technical things in there. It's too complicated. Like, I'm just not there. And that kind of uncertainty leads you to follow those people that we talked about earlier who are like saying, hey, just follow my plan and you know, you'll make millions, like easy. Lambos left and right. You know, you want yellow or red? No one wants a red Lambo.
Green's my favorite color. I'm just saying.
Green is a good color. So one, it's hard to, and the hard part is, unlike OVTLYR that does show the expectancy, I haven't seen anyone, even like mature companies, I don't want to name names, never mind, you know, YouTube hacks, but just mature companies, they never say, here's the expectancy of what I'm trying to teach you. I can teach you how to trade options, and here's, you know, call, put, spread, butterfly, condor, you know, let's name all the animals over here. But the reality of it is they never show it. They say, hey, look at the awesome trade I did. And they have 300 hours invested in their kind of intuition. So they know, oh, it bounces off of this support level, this support level. So one of the things that I'm realizing, it's okay not to have a plan, but to begin with, but take someone's plan and modify it. Know that there is expectancy to that plan. And if you have an idea, backtest it or learn how to backtest it. Don't just rely on a guru. You know, even OVTLYR, like, I don't want to rely on OVTLYR. I want to learn myself. I want to know that my test, or my backtest, or my data will give me the outcome that I'm looking for. And if I don't know how to do that, there better be data behind that so I can make data-driven decisions. That's very important. If you don't have data, then you just have intuitions and feelings and everything else.
Yeah.
Right.
You gotta trust me,
the
bro.
trust me, bro. The beautiful thing that you did with Scott this summer is you went back 5 years or 4 years to look at the historical data, and based on that historical data, come up with a plan that worked. We were so excited for Plan A, and it was nothing compared to Plan M. And it was almost like the Plan ETF is even amazing. The fact that you shared those results is, you know, it really is a gift to all of us here.
That's why we want to teach you and help you be successful, right? Because the buy and sell signals on their own, they generate the positive expectancy on any individual stock. You can go see what that expectancy is. You can see what the capital efficiency is, right? And some of them it's not good. It's very true. But some of them, it's amazing. Like, we looked at one this morning, like 6,000% returns. Capital efficiency was over 5, meaning that each day that you were invested using the buy and sell signal was 5 times higher returns than buy and sell, buy and hold, right? And so the point that we had over the summer was, okay, we have OVTLYR, we have the data, we have the signals. Now, how do we take that and make a full comprehensive trading plan? That was the point. And so that's what you guys watched in real time. And now we share that. And I really appreciate you, Kasha, pointing that out, right? And I don't know anybody else that shares what their data looks like, because it's so much of a gut feeling, right? It's a, trust me, bro, it's going to bounce right here, versus, okay, based on the data that we have, this looks like the time to take our exit signal based on X, Y, and Z. And they don't have it.
They don't have the data.
They don't have
really
the data.
don't.
Exactly.
Chris, can I just say something as well, please?
Only if you don't freeze.
I'll try not to. Just to add to that, with we were talking about earlier on with the edge, it's the ability as well to realize when something's not working, to go back to the data and adjust and tweak. I think that's key with OVTLYR, and that's what we've all seen personally in this group, and Alpha obviously seen it as well directly, benefit from that. And the guys now seeing us develop, all because the edge has been tweaked and tweaked and tweaked,
Mhm.
and that an outlier itself has changed so much in what 9 months.
Oh
You see
yeah.
all the different
Oh my
versions
gosh.
coming out.
Let me tell you. The plan that I traded last year, I had 91.37% returns. I handed it to Scott and I said, "All right, man, let's make this as great as we can." When he got done with it, he was like, "Chris, this plan is garbage. It has like a 0.08% expectancy." And I'm like, "What? I just made 91% last year with it." And he's like, "You happen to catch all the right winners at the right times. But given enough instances, this is not great." And I was like, "Whoa, okay, so let's redo that." And to your point earlier, right? Plan A, we worked hard as hell on plan A. Only for plan M, with pretty much no modification other than the buy and sell signals, outperformed plan A instantly. And it's like, whoa, okay, all right. Well, let's see how far we can push this thing, right? And so you know, what I try and tell you guys is this may or may not be the best plan ever of all time. And I'm never going to say that it is, but it works for me. It works for my personality, and I have the data to back it up. So therefore, I can trade it confidently. I'm not scared of it at all. Will I win every trade? No. And I'm totally okay with that. But when I do win, by God, I'm going to let that thing run as far as it possibly can. Let's keep going here. So if you break your plan even just once, you never even had a plan, and then all of your data is skewed because you panic sold or you FOMO'd in to the next hot stock. All right. So it doesn't matter what I say. It doesn't matter who you learn from. If you cannot hold yourself to your own rules, you're never going to be successful in trading. It's like baking a cake, right? You follow the recipe and you're going to get a delicious cake. But if you go off script, who knows what you're going to end up with? But if you follow your plan, you're going to end up with the cake. A trading plan is a trading recipe, and you're the chef, and one wrong move and it will turn into trash. But unlike the chef, we have to be content with not knowing the outcome of any one trade, right? Because imagine if the chef puts the cake in the oven, 50% of the time it's going to come out great. The other 50% is going to go right in the garbage. That would be a hard life for a chef. And if you want to be a trader, it's going to be a hard life. It's the easiest or the hardest way to make an easy dollar because of that exact thing. We can't control the outcome. But over a series of trades, we'll eventually bake the most beautiful cake of all time. And this is one of the reasons why normal people fail. Because I want my cake. I put the cake in the oven. It should come out like a perfect cake every time. Every time it should come out like a beautiful cake. And unfortunately, it's just not going to happen. Unfortunately, it's just not going to happen. Man, this is going way longer than I expected to. So I apologize that it's going so long, but also I'm doing my best here, right? Thinking in probabilities. What does thinking in probabilities mean to you? I'm going to call in a couple names here. Actually, I can see the end in sight, but we do have some movie time up ahead. Art, what does thinking in probabilities mean to you?
Just using your probability to determine the outcome of a trade and not using the data to back it up.
Yeah, I like that. Mark, what does thinking in probabilities mean to you?
Well, it kind of goes back to creating the edge, so you can swing that 50-50 coin flip distribution into a more probable positive outcome over the time that you have to execute your plan.
Dude, perfect. The understanding that the more and more times you trade, the closer you get to the expectancy. You cannot give up and you cannot deviate from the plan. So, who brought the popcorn? Charlotte brought popcorn. I feel it. Right, Charlotte? You got popcorn over there? No, I'm just joking, Charlotte. You don't have to. You're good. You're good. You're good. Okay. So, what I want to share is 4 clips from videos from podcasts that I did with my mentor, Steve Burns. These are all a minute or two, but it's really fun to see. All of these are from 2019. Itty bitty baby boy Chris talking about how to trade directly from his mentor. Right. One of the most important people in the entire world to me is Steve Burns, and like I said, I've made over, good gravy, how many videos have I made? 2,500 videos at this point. 2,500 videos documenting the journey of trading. So let's watch a few of these together.
Good is not good enough, right? LeBron James didn't become LeBron James by being good. He became LeBron James by being incredible, by being excellent, by always consistently practicing, improving, becoming the top athlete he could. And he said, you know, traders need that mindset too. I'm not going to take a mediocre trade. I'm going to take the best trade I possibly can because it fits my risk return profile here. And you have to be flexible in the. Oh, I heard this in what book was it? Trading for a Living by Dr. Alexander Elder. He says something like, you know, be strict on your plan or strict in your signals, but flexible in the outcome. So you got to be strict in getting your fundamentals down. You got to be strict in knowing what you're going to do, but you got to be flexible on what's going to happen because you can hope for the best, you can plan for the best, but it doesn't always work out that way. Good.
Dude, that young man with those puffy cheeks and big ass headphones, probably 44% of the hair on his head. What a smart dude. What a smart dude. Let's watch another one here. Oh, look at that. Actually on video this time.
Or a tiny loss. There should never be a giant or a tiny loss. There should never be a giant loss. And I think a lot more people need to understand that, you know, it's okay to have a win rate much less than 50% if your returns are much greater.
Yeah, the major key to profitable trading is big wins. The major cause of unprofitable trading is big losses, and that's what you have to manage.
Yeah, and I think the management is really about your ego versus the stock price when that happens.
Yeah, the tools of every trade entry, really, once you enter a trade, it comes with the management. You know, where's your stop loss to keep it small? Where's your profit target or your trailing stop to make it big? And each day making a decision to maximize those gains, minimize those losses.
Mhm.
Really, it's the trade management that really you are your edge when you're able to manage your trades properly.
Wow, well said. You are your own edge when you can manage your trades properly. I love that.
I love that too, Chris. What a handsome young man you are with those, you know, shaven cheeks. And I don't know, you might not have that much more hair than I do. But you know what? That's such a great point, right? You create your own edge. You get to create your own edge. Let's watch this one.
I know that most new traders get into this with the whole Wall Street movie mentality, right? I'm going to risk $10,000, and you better believe, by God, that's going to end up to be $14 million by the end of the week.
It's so funny, the thing people miss on the casino winners. You know, how many casino winners, how many people do you know go to the casino? They do have a big winning streak against all odds. They do beat the casino. They have, you know, up huge, whatever it is for them, thousands, $10,000s of dollars. And then they still either stay too long and let the casino's edge play out and give it all back, or they come back and over the long term, they lose it all back slowly to the casino. So even if they win against the casino when they have no edge and no plan, then they still in the long term lose and give it all back. That's the same thing with trading.
I know that most new trade.
So I have one more. And I find these fascinating that I was having these conversations in January of 2019, right on the internet for everybody to see, and it got 608 views. But you know what? Maybe 608 people had their lives changed from that conversation.
Cynical, like I'll post compound growth of capital tables on Facebook, on my personal Facebook, just showing people what you could do if you took capital and compounded it over a long period of time. I'll just use like 8%, and people come out endlessly say, that's impossible. We're going to get 8% return. This is crazy. And I'm like, man, I did this in real time. I really did that. I have the money. I'm financially independent. I'm done. I did that with several huge bull market runs. I mean, even buy and hold in SPY got about 8% on average. So I don't understand the cynicism for people who they failed or they weren't able to do it or they went through their own pain. So they project their cynicism of impossibility on everybody. You know, most people can't play NFL football, but there are several thousands of successful NFL football players over the last 40 years.
Hey, that's a great point.
Yeah, did make it. There are saying, no, nobody can play NFL football. It's a complete waste of time to go play high school football or college football. It's impossible. No. The people who go through, like you said, there are people that really did it. To be cynical and say it's impossible is just absurd.
And so back to the point that I was trying to make earlier is that if you want to make abnormal returns, if you want to be an outlier, you can't be normal. Going through these type of lessons is what's going to separate normal people from outliers. So you get to choose, right? You get to decide, do you want to be normal or do you want to be an outlier? They are mutually exclusive. And that is just the beginning of thinking like a successful trader. We'll be revisiting this again on Thursday. So thank you all so much for coming to class. Apologize that it took so long, but you know what? I want you to be successful. And that is why I care so much and I'm putting so much effort into OVTLYR University is we want to make money with you, not from you. And the best thing that I can do is set you up for success. So if anybody were looking to, I don't know, save time, make money, and start winning with less risk, what do you guys think that they should do? Click one of these two videos showing up on the screen right now. That is a fantastic idea. Thank you all so much for coming to class today. Thank you so much for watching live. And we will get out of here. We will talk. We'll talk again soon.